In March 2026, one of the most important brands in global finance crossed a line. S&P Dow Jones Indices licensed the S&P 500 to trade XYZ for a new perpetual contract. It would trade 24 hours a day. It would exist on-chain. And the infrastructure underneath it was not NASDAQ, not a traditional futures exchange. It was Hyperliquid. For years, decentralized exchanges had a fairly simple problem. They could be transparent. They could be permissionless. They could let users hold their own assets. But when serious traders wanted speed, liquidity, and an actual order book, they usually went somewhere centralized. Hyperliquid attacked that trade-off directly. It built something that feels remarkably similar to a centralized exchange, but moved the machinery underneath it onto a blockchain. And that changes the real question. This is not, can a DEX beat Binance? The more interesting question is, what happens when the exchange itself stops being a company product and starts becoming infrastructure? Welcome to BlockDocs. Most people think an exchange sells trading. It does not. It sells several things bundled together. First, custody. You deposit assets and the exchange maintains your balance. Second, execution. The exchange runs the matching engine, deciding which buy order meets which sell order. Third, liquidity. Market makers gather around the venue because that is where the traders already are. Fourth, distribution. The exchange controls the interface, the listings, and the relationship with the customer. That bundle created an extremely powerful network effect. Traders want liquidity. Market makers want traders. New tokens want listings. And new users go where all three already exist. That is why copying the interface of a centralized exchange was never enough. The real moat was the market underneath it. For an on-chain exchange to become serious, it had to break that loop. And the first problem was brutally simple. Speed. Early decentralized exchanges often avoided the traditional order book model. Automated market makers replaced buyers and sellers with liquidity pools. That design was powerful. But a professional derivatives trader does not necessarily want a pool. They want bids, asks, limit orders, cancels, precise execution. They want an order book. Hyperliquid built one directly into its layer 1. Every order, every cancellation, every trade, every liquidation. The protocol records them on-chain, and orders are matched using price-time priority, the same basic logic familiar from centralized markets. The difficult part was making that architecture fast enough to feel normal. Hyperliquid calls its consensus system HyperBFT. Its documentation says the network currently supports roughly 200,000 orders per second. For a geographically co-located client, it reports median end-to-end latency around 0.2 of a second. Small disclaimer. Those are protocol-reported performance figures, not an independent benchmark. But the significance is larger than the exact number. Hyperliquid did not make traders choose between an order book and an on-chain system. It tried to give them both. And once execution moved onto the chain, another piece of the exchange could move with it. Custody. On a centralized exchange, your account balance ultimately depends on an intermediary maintaining custody correctly. Hyperliquid changes that arrangement. Its trading collateral comes from a self-custodial address. According to Hyperliquid Labs' submission to the CFTC, there is no exchange omnibus account required to operate the protocol, and contributors do not custody or rehypothecate user funds. That does not remove risk. It moves it. Instead of asking, do I trust this company with my assets? The questions become, can I secure my private keys? Can I trust the protocol code? Can I trust the validator set? Can I trust the liquidation system? That distinction matters. Decentralization does not make financial risk disappear. It changes where the risk lives. And Hyperliquid moved another traditional exchange function as well. An exchange can have perfect technology and still be useless. If nobody is standing on the other side of the trade, there is no market. Hyperliquid's answer is not simply to wait for liquidity to appear. One part of the system is HLP, the Hyperliquidity provider. HLP is a protocol vault. It runs market-making strategies. It participates in liquidations. It supplies capital into parts of the system, and users can provide liquidity to that vault and receive a share of its performance. This is important because exchanges have historically concentrated some of the most valuable flows around privileged operators and market makers. Hyperliquid tries to expose more of that machinery. Even its liquidation flow is visible. Most liquidations are first sent directly into the order book. If the market cannot absorb them, and an account falls far enough below maintenance requirements, a backstop liquidator vault can inherit the position. That sounds elegant, until the market being liquidated is small enough to manipulate. We will come back to that, because the system eventually discovered exactly where this design could break. But before that happened, Hyperliquid solved another problem that may be even more consequential. It allowed other businesses to build on top of its liquidity. This may be Hyperliquid's most important idea. The interface does not have to own the exchange. Hyperliquid supports something called builder codes, a wallet, a mobile trading app, a professional terminal, a completely different front end. All of them can route orders into the same underlying liquidity and charge their own builder fee. Hyperliquid's own documentation says independent applications using this infrastructure have already generated more than $45 million through builder codes. Think about what that means. A traditional exchange tries to own the trader. Hyperliquid can let somebody else own the interface while the protocol owns the liquidity layer underneath it. That is much closer to financial infrastructure than a normal trading website. Then came HIP3. Instead of Hyperliquid deciding every perpetual market itself, builders can deploy their own perpetual DEXs on HyperCore after meeting staking and risk requirements. They define the market. They operate its oracle. They can earn part of its fees. And the same underlying Hyperliquid infrastructure handles order books and margining. This is how the S&P 500 enters the story. Trade XYZ did not need Hyperliquid to become a traditional stock exchange. It used Hyperliquid as the machine underneath a new market. S&P Dow Jones. Indices supplied the officially licensed benchmark. Trade XYZ supplied the market. Hyperliquid supplied the rails. That is the first major payoff. Hyperliquid is not simply trying to steal users from centralized exchanges. It is trying to turn the exchange stack into something other companies can build on. There is an irony buried inside this system. Hyperliquid is competing with centralized exchanges, but parts of its risk engine still look at them. Hyperliquid's mark price, the price used for things like margining, unrealized profit and loss, and liquidation, is built from several inputs. One of those inputs uses perpetual market prices from centralized exchanges, including Binance, OKX, Bybit, Gate, and MEXC. That does not make Hyperliquid centralized. It reveals something more interesting. You can decentralize execution before you decentralize price discovery. Markets remain connected. Arbitrage connects them. Oracle design connects them. Liquidity connects them. Hyperliquid may compete with Binance for traders, while simultaneously using Binance as one reference for what a fair market price looks like. That is why the phrase DEX versus CEX is slightly misleading. These systems are not isolated armies. They are already part of the same market structure. And that interconnectedness became painfully obvious in March 2025. March 26, 2025. A small and relatively illiquid token called Jelly became a stress test for the entire model. A trader built a large leveraged short position. Coordinated trading activity then pushed the market into a situation where the position was liquidated. Hyperliquid's backstop system inherited the trade. The problem was that the position itself had become dangerous. As Jelly moved sharply higher elsewhere, HLP was left holding a toxic short. A later SEC filing describing the event estimated losses to HLP liquidity provider vaults at roughly $13.5 million. This was not described as somebody stealing private keys. It was not a conventional smart contract hack. The market mechanics themselves had been gamed, and eventually the validator set intervened. Jelly perpetuals were delisted. Positions were settled. That intervention contained the problem, but it also created a much harder question. If validators can intervene when markets become dangerous, then where exactly does the exchange end and governance begin? This is not a gotcha. Centralized exchanges intervene too. They halt markets, change margin requirements, delist assets. The difference is that Hyperliquid claims to move these decisions into a transparent blockchain system, so the standard becomes higher. The rules need to be visible, the decision makers need to be understood, and the limits of decentralization matter. Anyone can run a Hyperliquid validating or non-validating node, but not every validator participates in active consensus. The active set is currently the top 24 validators by stake. Block production is stake-weighted, and validators also participate in decisions such as market delistings. That is decentralized relative to one company operating one matching engine. But it is not decentralization without concentrated decision points. Hyperliquid's own foundation also operates a delegation program intended to strengthen and diversify the validator network. Participation requires minimum self-stake, operational requirements, and KYC or KYB. Again, this is not proof that the network is secretly centralized. It is evidence that decentralization is a spectrum with engineering trade-offs. Hyperliquid chose speed. It chose an on-chain order book. It chose a relatively compact active validator set capable of supporting that performance. The real test is whether that system can broaden its trust base without losing the performance that made traders care in the first place. So, is Hyperliquid going to kill centralized exchanges? That is probably the wrong question. Centralized exchanges solve problems that Hyperliquid does not eliminate. Some users want an account, customer support, fiat access, a company responsible for the interface. Others want self-custody and transparent execution. But Hyperliquid has demonstrated something more fundamental. The functions we used to call an exchange do not necessarily have to live inside one company. Custody can sit with the user. Matching can sit on-chain. Liquidity can come from independent market makers and protocol vaults. Applications can own the customer interface. Builders can launch markets. And the underlying exchange can become a shared financial rail. But there is a catch. Risk also gets unbundled. You exchange custodial risk for key management risk, corporate discretion for validator governance, opaque matching for software risk, and dependence on one exchange's balance sheet for dependence on oracles, liquidity, and consensus. That is why Hyperliquid matters. Not because it proved that centralized exchanges are obsolete. It did not. It proved that one of their biggest historical advantages, the ability to operate a fast, liquid order book, no longer has to remain completely off-chain. And once the S&P 500 can exist as a licensed perpetual market on those rails, the fight becomes bigger than crypto exchanges. The fight is over who owns the infrastructure where the next generation of markets actually trades. Hyperliquid may win that fight. A centralized exchange may copy parts of the model, or the final system may combine both. But the old line, centralized exchanges for performance, decentralized exchanges for transparency, is already becoming harder to defend. The exchange war is no longer just about where traders open an account. It is about which parts of the exchange still need an owner at all.